Multifamily Financing Basics, a guide for commercial real estate investors. In multifamily real estate can be an attractive way to build long-term wealth and generate recurring cash flow, but also to scale a commercial real estate portfolio. But finding the right apartment property is only one part of the investment equation. So how you finance a multifamily property can have a major impact on your cash flow and your return on equity, and also the ultimate success of the investment. So, for investors considering apartment buildings, understanding the fundamentals of multifamily financing is just the most important step. So, what is multifamily financing? And in commercial real estate lending, multifamily financing generally refers to loans that are secured by residential properties that have five or more units. And properties with four units or less are typically treated as residential transactions. So that's why five or more is what becomes multifamily lending. So that distinction matters because lenders increasingly focus on property economics for commercial related transactions. And they want to understand the net operating income or NOI, but also the debt service coverage ratio or DSCR and the loan to value ratio or LTV, but also the occupancy and historical operating performance, the rent roll and tenant profile, and the property condition, the borrower's liquidity and net worth, but also their multifamily ownership and management experience. And a strong property combined with a well-qualified sponsor can create significantly more financing options. So some common types of multifamily loans, and really there isn't one universal multifamily loan, and different properties and investment strategies may require very different capital structures. So there's conventional bank loans and credit union loans. And banks and credit unions are often a logical starting point for stabilized apartment properties. And these lenders generally offer pretty competitive pricing, but their underwriting can include substantial scrutiny of both the property and the borrower. And institutions often require banking relationships. And conventional financing can work particularly well when the borrower has strong liquidity and good credit and experience, or maybe an established relationship with a lender. There's also agency multifamily loans, and agency financing can become particularly important for larger, stabilized multifamily properties. And programs associated with Fannie Mae and Freddie Mac can provide attractive long-term financing for qualifying multifamily assets. And agency execution can be especially compelling for experienced investors who are seeking competitive leverage with longer amortization and financing designed around specifically for multifamily properties. But there's also FHA multifamily financing, and certain multifamily projects may also qualify for programs insured by the Federal Housing Administration, or FHA. And FHA multifamily programs can be particularly relevant for larger acquisitions or substantial rehabilitation projects or new ground up construction. And these programs offer compelling structures, but underwriting in the closing process can take substantially longer than a traditional conventional commercial loan. There's also multifamily bridge loans, and not every apartment property is stabilized when it's acquired. And perhaps occupancy is a little low, and units need renovation, or the rents are below market, or management needs to be replaced, or the property's historical NOI doesn't really support financing. And that's where multifamily bridge loans can be really useful. And bridge loans are typically short-term financing solutions designed to provide investors time to execute a defined business plan. So a typical strategy might look like acquire it and renovate it, and then increase the occupancy and the NOI, then stabilize it, and then refinance. And the exit strategy is critical, and investors should ask whether a bridge loan and compare it with permanent financing and what it could like, or just what it would look like as a refinance after it's stabilized. And DSCR is one of the most important multifamily metrics. And one of the first calculations investors should understand is DSCR. And that basic calculation is that debt service coverage ratio is the net operating income divided by the annual debt service. So for example, assume an apartment property generates $300,000 of NOI. And if your loan is $240,000 in principal and interest payments, That DSCR would be 300,000 divided by 240,000. And that's a 1.25 DSCR, 1.25. So it means you generate $1.25 for every dollar of payment. And a higher DSCR generally provides a larger financial cushion, although minimum requirements vary considerably lender by lender, by market and transaction, but 1.25 is usually a good benchmark. So understanding loan to value. Another fundamental that multifamily financing metric revolves around is LTV. And that's pretty straightforward. It's the loan amount divided by the property value. So if you have a $10 million acquisition and the proposed loan is at $7 million, you've got a 70% loan to value. But investors need to understand an important underwriting concept. The maximum LTV does not necessarily determine the maximum loan amount. And debt service coverage ratio can constrain your proceeds before loan to value does, or debt yield as well. Say, for example, an investor might request 75% loan to value, but the NOI only supports a smaller loan. The lender's going to have to reduce that loan amount, and you're going to have to bring more equity. So why NOI matters so much? Well, multifamily financing ultimately revolves around the property's ability to generate sustainable income. And that makes net operating income critical. An NOI generally represents property revenue minus the operating expenses before the financing costs, the income taxes, depreciation, and certain capital expenditures. So investors should carefully analyze the current rents, the market rents, the vacancy, what concessions they need to get the building filled, other income or any property taxes, what does the insurance look like, the repairs and maintenance, are we paying utilities, do we have payroll or management expenses, and replacement reserves. And a small underwriting adjustment can have a surprisingly large effect on value and loan proceeds. An interest rate isn't the only thing that matters. And of course, borrowers naturally focus on interest rate, but the lowest quoted rate isn't automatically the best financing. And investors should evaluate the entire capital structure, including your interest rate, your loan amount, the amortization, whether it's fixed or floating rate, any interest only periods, what's our loan term, is this recourse, what are the prepayment provisions, what are the closing costs, the reserve requirements, is it assumable, are there any cash management provisions, are there any required guarantees? And sometimes a financing option with a slightly higher interest rate can produce superior investment outcomes because it provides better leverage or flexibility or proceeds or prepayment terms. And my point is match the financing to the investment strategy. And that's where multifamily financing becomes strategic. And a stabilized apartment complex intended as a 10-year hold probably shouldn't be financed the same way as a distressed property undergoing an 18-month renovation. So before choosing a loan, you need to ask, what am I trying to accomplish with this property? And a value-add investor may prioritize flexibility and future funding, whereas a long-term hold investor is going to prioritize fixed-rate debt and predictable payments more. And an investor who's preparing to sell a property may prioritize your prepayment flexibility. And the business plan should drive the financing strategy and not the other way around. So prepare before approaching lenders. And well-prepared borrowers can make our underwriting process significantly easier and a better experience for them as well. So a typical multifamily financing package needs to have a rent roll, a trailing 12-month operating statements, historical financial statements, a purchase contract, a property summary, the sources and uses of the funds, a renovation budget if necessary, a borrower's personal financial statement, a schedule of real estate owned, bank statements to support the liquidity, a borrower's resume, the ownership structure, and a business plan. And providing lenders with a clear picture of the transaction allows them to evaluate the opportunity more efficiently. So why shopping the capital markets matters? Well, one of the challenges with multifamily lending is that different lenders can view the same property very differently. And a local bank might like the sponsor but limit the leverage. And another lender might offer greater proceeds but require more reserves. And an agency lender might provide attractive permanent financing, but require the property to meet specific stabilization criteria before they'll make the loan. And a bridge lender may accept the property's current performance because it's underwriting the future business plan and not the current financials. And this is why investors should think about what they're trying to do before asking, so what's today's multifamily mortgage rate? Well, a better question might just be, which financing structure is going to be the best way for me to accomplish my investment strategy? So here's the bottom line. Successful multifamily investing requires more than just finding a good apartment property. Investors must also understand how NOI and DSCR and LTV and interest rates and amortization and lender requirements, but also the business plan and how everything intersects. And the right financing can improve cash flow and preserve capital and provide flexibility and position the property for its next stage. And the wrong financing structure can create unnecessary constraints even when the underlying property is strong. My name is Bill Rapp. I'm with the CommLoan Empower program, and my objective is to help commercial real estate investors evaluate financing alternatives and identify capital structures that align with their investment strategy. So if you have a multifamily acquisition or refinance you're evaluating, let's talk about the numbers and determine which financing options make the most sense for the deal. That is it for the day. Thank you for watching. You can visit my website at billrapp.comloan.com. I appreciate your time. You take care.